Hello and welcome to our discussion on accounting for business combination and preparation of consolidated balance sheet. This is Professor Ramana. Let me first recap the relevant accounting standards which affect the business combination and consolidation are IFRS 3, Ind AS 3, AS 14 of India, that is for amalgamation, and IAS 27 is the consolidation accounting. There are two important things. There is a determination of purchase consideration and discharge of purchase consideration. The purchase consideration can be determined by asset base. That means the purchase consideration is equal to the market value or the book value, depending on the information available, of assets minus liabilities. Sometimes purchase consideration can also be determined on the basis of earnings. So I would say that purchase consideration is the present value of the free cash flows of the firm. Or it can also be on a market price based, where the purchase consideration is the shares acquired into the market price of the share. So as we move along, we'll pick up examples showing the determination of purchase consideration by using one of these methods. And the purchase consideration determined can be discharged through cash, through shares, or through bonds and debenture, or combination of the above. So one is the determination of purchase consideration, other is a discharge of purchase consideration. Based on the purchase consideration, two other related issues which are required for consolidated balance sheet is the determination of goodwill and determination of the minority interest. Goodwill is the excess of the money paid or excess of purchase consideration over the proportionate equity acquired. If PC is greater than the equity acquired, there will be a positive goodwill, and if the PC is less than the equity acquired, there will be a negative goodwill. The minority interest, which is also called non-controlling interest, is the equity of the seller other than the equity taken by the holding company or the majority shareholder. And the minority interest will appear on the balance sheet of the consolidated balance sheet and under the heading equity. Now let us take an example. So this is a balance sheet of A and B, and information is in million. They have capital, reserves, long-term debts, current liability, fixed assets and investment, and A acquired 70% of shares of B at book value per share, and these are discharged through shares of A at rupees 10. So we will try to understand the preparation of the consolidated balance sheet and the standalone balance sheet. First, let us do some working. The workings will show the total equity of B, purchase consideration, minority interest, how they discharge, determination of goodwill. The total equity of B here, because the market value or the fair value is not given, so equity is equal to the capital plus reserves is equity. And if this is the total equity of A, the total equity of A belongs to, the total equity of A belongs to, total equity of B belongs to the majority shareholder A and the minority shareholder other than A. So if equity of the company is 600, the number of shares is 100 divided by 10. So the book value per share is equal to 600 divided by 10. So book value per share is required here because the purchase consideration is determined on the basis of the book value per share. So book value is an input required for the determination of the purchase consideration. And of this equity, if I say the total equity which is already given, calculated here, is 600, the minority interest is 30%. Okay, minority interest is 30% because 70% is taken over by A. So minority interest is 600 into 0.30. Okay, now we'll see the the calculation of purchase consideration. They say that purchase consideration has been the company has been acquired at the book value per share. So the shares acquired, okay, shares acquired by A is okay, before that let me write down total shares of B. Total shares of B is 100 divided by 10, so 10 million. So A acquires 70% of that, so 0.70. And at what price? It is acquired at 60 book value per share. So PC is equal to book value, purchase consideration is equal to the number of shares into the book value per share. The number of shares into book value per share. Okay, so book value per share, number of shares. Okay, so 420 is a purchase consideration. That means A has to pay or give to B 420 million. Why? Because they've acquired 7 million shares at the book value per share, and the book value per share in this case, the book value per share in this case is 60, and the 60, because the equity of the company is 600 and the number of share is 10 million, so therefore book value per share is 60. Okay, so that is the purchase consideration, 420. And how are you discharging this? How is A discharging that purchase consideration? 420. The purchase consideration is discharged through the issue of shares, and issue of shares at the face value of 10. So the share price issued is 10. So the number of shares issued will be 42 million, and so the capital will be 40 into 10, and there is no share premium, so the entire purchase consideration has been discharged through the issue of shares at par. And goodwill purchase consideration minus the equity acquired. The equity acquired is equal to, you can see that the total equity of B is 600, and A acquires 70% of that, so therefore there is no goodwill because the acquisition has happened at the book value. Now we have all the information required to prepare standalone and the consolidated balance sheet. Let us first prepare the standalone. So A's balance sheet will show 600 plus the capital which has been issued, no change in the reserves, no change in the long-term debt, no change in the current liabilities, the fixed assets, no change, investment will appear at the purchase consideration, and no change on the current assets, okay, because you have not paid, so through cash. So the change in a capital is because of the issue of shares, because of the discharge of purchase consideration, and investment will appear on the balance sheet. Investment will appear on the balance sheet as the value of the purchase consideration. So therefore the consolidated balance sheet will show the asset, investments, and the corresponding increase in the capital. In the consolidated balance sheet, you can see is a consolidation, is a line by line consolidation, but line by line consolidation happens for the liabilities and assets other than the investment, and on the sources side no consolidation for the capital and reserves of B. So in a consolidated balance sheet of A, the capital of A, the reserves of A, the debts of A plus B, the current liabilities of A plus B, and since there is no goodwill, since there is minority interest, there is a minority interest which we calculated here, and fixed asset, again the assets of B plus assets of A, investment will not appear anymore, and the current assets are of A plus B, and goodwill, in this case there is no goodwill, so goodwill is 0. So you have the consolidated balance sheet. But observe that in a consolidated balance sheet the investments will not appear. Similarly, the capital and the reserves of B are not consolidated, because instead of showing the assets and liabilities, instead of showing the investments and the capital and reserve, the assets and liabilities of B are shown. Any excess will be shown as a goodwill. So in this example we just limited to show a calculation where there is no goodwill, and no goodwill because A acquires B at the book value, and the book value per share is 60 because 600 is the total capital and reserves. In the next section we'll take more or less a similar problem where we'll come across goodwill. Thank you very much.